Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, June 6th, 2023. Welcome back to the podcast, George.
Great to be back as always.
Always good to have you, bud. So we're kind of waiting on we were kind of waiting on the resolution of the debt ceiling debacle before having you back on, because it's sort of hard to have, the shelf life on a podcast is only so long. Now that uncertainty is out of the way, what should our warriors, quote unquote, worry about next?
It's good to be back, and look, I think it's great to see that we've moved beyond what was a really a fabricated crisis, but at the end of the day, it had to get done, and it's good to see that there's at least a solution that will get us through the election cycle, and hopefully in the interim, policymakers will also focus on debt sustainability and other issues that still have to be dealt with. But at least for now, the kind of the threat of the default is obviously gone, and the markets can kind of move on to something else. I mean, that was the big worry that was preoccupying markets, and really, as I wrote in my last monthly, was really potentially a distraction to what's happening in the underlying economy, both in the U.S. and globally. In the U.S., we still keep getting a mixed picture, and it's really hard to handicap. And I'll come back to in a second what's going on with like the labor market versus other sectors of the economy. And then you have what's happening with Europe, with Germany supposedly in a technical recession, and every single data point since we've gotten that news has suggested that Germany really is decelerating in a pretty big way, which should have implications for the broader eurozone. And then China, the reopening, which really never happened or hasn't really met the expectations that were earlier in the year, expecting for a really grand, big reopening that would have led to a bigger growth impulse for the global economy, helping all boats rise. And we haven't really seen that either. So we kind of these two big narratives at the start of the year, which was a more robust Europe without the energy crisis that was many were feared, a better weather in Europe, yet Europe still managed to kind of decelerate into this environment. And then you have China still not firing on all cylinders. And I think the best reflection of that is really captured in the oil price, which also recently was in the news with the OPEC suggestion for a cut of further production. I mean, I think the global economy basically is decelerating, and the U.S. has been decelerating too. But really, the last really thing to kind of prove this has been a jobs market that's still on the surface, at least for some numbers, looks healthy. But as I've discussed many times, there's cracks forming there as well, and we'll see what happens in the second half. But the uncertainties that kind of go forward from here, I think, go back to some of the early concerns that we had at the in the beginning of the year around the banks still with if that potentially might be on hold for longer at a higher rate, and maybe might still want to raise rates again. We'll see at the upcoming Fed meeting. But I do think that the kind of regional banks spill over into maybe other non-bank entities, things that we've discussed, hard to pinpoint, but that's still out there in the backdrop. And speaking of Europe also has a bunch of liquidity that might be coming offline. The post-pandemic liquidity that was offered expires in the upcoming month, and that might also have an impact on the European banking system, which up until now hasn't really been in the news. But I think if we were to see some sort of issues around that, would garner more focus from the broader markets. And then further afield, at some point, this slowdown that we've all been kind of anticipating has to come to fruition or not. And I think that realization will be something that we're going to be analyzing over the course of the summer and into the early fall. Will that eventually result in more corporate profit margin compression? We've discussed both, I think, on the podcast, but also over the course of the last 6 months, this idea of a full employment recession, which was also mentioned this week in the Wall Street Journal article with basically the exact same title. That perhaps what's odd about this slowdown is the full employment nature of it, but then we're hearing about productivity not being as high as it used to be. So there's all these again cross currents, some cracks forming in the labor market that eventually corporate profits either take a hit because they're going to keep their labor force large, or eventually they're going to have to start laying off people, right? So I think that those are still medium term risks to kind of focus on. But I think the big one in the short run is going to be liquidity draining, both again from what I just mentioned from the ECB side, and also what's happening now, post debt ceiling with that resolution. There's going to be a ton of Treasury T-bill issuance and potentially changes to the way the Treasury funds itself, and that money is going to have to come from somewhere, and that liquidity draining will happen over the course of the summer as well. And so all these things take time to kind of get to a point where we actually see the impact, but it's still going to happen, and that's what I'm really focused on.
Yeah, absolutely. I mean, as you mentioned, a ton of cross currents. Said it another way, a lot of mixed signals. Kind of feels to me like that's sort of what you get at economic, turning points. But I am, as you know, personally, I'm sympathetic to that sort of jobful recession, idea. So, the only thing that is predictable is unpredictability. So it certainly will be an interesting next couple of months. But you've been focused on that liquidity story for a long time, and I really agree with you. That has the potential to be a big deal. And I would argue, unlike other themes in that are, sort of common in markets, sort of difficult to pre-position or discount ahead of time, kind of hard to, handicap or forecast what happens, what the effect of that is on, rates, asset classes, and other asset classes when the Treasury drains all that liquidity, which also mean it floods the market with high yielding HQLA that could really crowd out other asset classes. So how are you thinking about it?
Yeah, no, it's a very complicated problem to break down. Although simple at the very high level, the U.S. By trying to stay under the debt ceiling had to issue less securities, and a lot of that reduction in issuance was in the short-term bill sector as those bonds matured faster. And and they also tapped into a lot of other programs to have cash to get through this resolution. Now they're going to have to go replenish a lot of these intra-federal accounts like pensions and things like that, and they're also going to have to raise up cash to have on availability in what is known as the Treasury's general account, which sits on the Fed's balance sheet, and that is as a liability, and that competes with from a just from a balance sheet perspective with reserves in the system, as well as a new program which has been with us for a number of years now, but relatively new in the grand scheme of things, the reverse repo program, which is largely offered to money market funds as an alternative to where to place their cash. A lot of the cash that's been sloshing around in the system, now offering a higher yield, no less, have made their way to the Fed's balance sheet. And so if you kind of think about those three big moving pieces, and as we kind of say and mentioned in a piece that we published and posted on our macro strategy marketing website, it's all about following the cash, and which now pays a decent rate. And will that lead to some crowding out of other investments? I think it will. But if we were to kind of take a step through, like just think through how this will work, the Treasury is going to have to issue a lot of new securities and raise cash, and that cash will then get, in theory, deposited or warehoused on the Fed's balance sheet as a liability in the Treasury's general account, like a checking account, in which kind of are like the Treasury's versions of their own reserves. And to fund that, either money will have to be sourced either from the money market funds themselves, which could decide to change their allocation to the RRP or not. And so they could either just reduce their balances at the Fed from the RRP and then take some of those proceeds and then go and physically buy T-bills at a QSIP level, and or the reserves that are in the banking system, private sector or the banks themselves can decide to buy the T-bills, and that will then shift reserves out and into the Treasury's account. Nonetheless, we don't know how this will all shape out, but historically, there's been kind of a bias that many times when we have these debt ceiling impasses and then there's a resolution, almost like the majority of the underwriting of these bills actually comes from the private sector more so, and from private investors instead of actually the money funds themselves. But we've never had a money fund concentration this large of over 2 trillion sitting at the Fed. So, I mean, people have been handicapping it. It's going to be 30-40% might come from the RRP. We just don't know. I mean, ideally, I think they would like to see 100% come from the RRP, but that's probably not going to happen. So, it's really a case where we have to monitor how these bills are going to be underwritten. Where is that source of cash coming from? And then that will drain liquidity either from inert money like the RRP, which is just sitting there, or it'll come from the banking system where the money is much more fungible, which could be used for other investments, for other consumption, whatever. And we've modeled and shown charts in our recent reports as well as historically how the reserve balances has a decent kind of correlation with things like the S&P 500 or crypto assets, and it's a kind of high-powered money. If it makes its way through the system, it has an impact on valuations. And so if there's going to be less liquidity because it's moving towards the T-bill market, in theory, that should leave a footprint on these asset classes, especially risk assets. So this is, again, pretty complicated. I just went through a few minutes explaining it, and there's a lot to it more than that. But at a very high level, it's going to come down to where they source the cash to underwrite all these bills, and the mix from the reserves versus RRP will play a crucial role in that. And then it will potentially have an impact of shifting, capital away from the capital markets and risk taking and more towards treasuries, which could lead to crowding out, which historically, we've never seen T-bills this high. And if the numbers that people are projecting of close to $1 trillion has to be issued over the course of the summer, that's a pretty hefty number to underwrite in a short time period, and could lead to less liquidity for other asset classes.
Yeah, compelling argument. And this financial markets plumbing stuff, like really when you go through it, it's not that complicated, but the totality of it's really complicated. Subtle but important point, if that money comes from the reverse repo facility, not much of effect, but if it comes from the banking system, could be significant. So thanks for clarifying that for us. So let's move on here. So, as you and I have discussed on the desk, this week's pretty light on data. Overall, markets feel like a bit, in a holding pattern ahead of some key events, most specifically CPI next Tuesday and the FOMC next Wednesday. The market's pricing in a small chance the Fed hikes, but more likely that they hike in July. What are your core views as we head into these events, particularly the Fed next week?
Yeah, no, so I think that this is a good week to reassess views. We've had a pretty big move in a lot of different asset classes, more so outside of rates, but even rates have had a decent backup. And the question, I guess, taking it from the top, these are all short-term views. I think it's good that we're focusing on the micro tactical trades or ideas into next week, because a lot can change with CPI and the Fed, and we'll cover that when we get there. But between now and then, I think it's really a good time to think about, which assets have performed versus what hasn't performed. Looking at, like IG versus mortgages, is there something there to be done? I mean, we've had a decent amount of spread compression in credit products. And, based on my macro outlook for the second half, I mean, it probably does, behoove those that are with credit long risk to lighten up on risk, because I think the credit is going to widen once again as we kind of face this kind of macro day of reckoning of eventually the jobs market will relent and we'll see a proper recession unfold, and delinquencies and defaults will pick up even further. So I think credit probably has run a lot ahead of itself here. And so, maybe taking a chance to kind of figure out, where to be defensive there. Similar story with risk assets, especially the stock market, which has become very concentrated in really the tech sector, to be honest. And if we don't see a broadening out of equity risk into other industries, then that too seems to be have gone as far as it can really go. And then if we talk about rates. We just had last night the RBA surprise. There was only 10 out of 30 economists that were expecting a hike, and so there is still this uncertainty out there, which is why it's keeping rate vol a little bit higher than it should be. Because if we're getting close to the end of a hiking cycle, or already have seen the end of the hiking cycle, vol should be coming off more than they have. I think it's just kind of that lingering fear that we just don't know if they're going to do this start, stop, or skip hikes, pause. And so the markets are still nervous around rate expectations. But for the June meeting, look, it's going to come down to the dots, and I'm sure we'll have another podcast before then, and we can go more into the Fed preview. But I think this is a time to reassess. Can central banks continue to push forward if we are starting to see some of the the cracks form in what is really the last good area of the economy, which is the labor market? And then will we have these episodes of just sometimes surprises out of nowhere, where you get rate hikes, which would be hard to discount in the marketplace. This kind of stop go is very different from what markets are accustomed to, like a very linear process of rate hikes, and then they stop, and then we just kind of see if we can handle these higher rates. If it's going to be an evolution still, and they hike again in July, it means that rates markets will be on edge until we cross the July meeting, and if they don't hike then chances are they're probably done for the cycle, right? So I think rates having stayed under Fed funds all throughout this period since really October, fourth quarter of last year, the 10-year and the 30-year have been basically under Fed funds all throughout, and being very skeptical of the Fed's intentions of keeping rates higher. It's only the 2-year that tried to make a run in early March, and even then, now two still trade under Fed funds. To get a full normalization of Fed funds, I mean, I guess that's the risk out there. But I think, still take the view that we're closer to the end, if not the end of the cycle. And the next thing that's going to happen is the re-steepening of the curve, which should argue for twos to have some support. But they're starting from such an under the Fed funds level kind of perspective, which makes it tricky. So I feel like basically we're this holding pattern persists until we get clarity from CPI and the Fed, but it could come at the at expense where risk assets, if they don't get what they are hoping for, which is more accommodated Fed, and if rates were to kind of grind a little bit higher into the middle of the summer, then it's probably risk off everywhere.
Yeah, I mean, I think, both of us have sort of been surprised at how well risk is held in, whether you're looking at, IG spreads, kind of near cycle tights, despite, what looks to be a looming recession. Stock market, as you mentioned, the rally's been pretty narrow. We saw, and I totally agree, seem to be in this holding pattern, but stuff actually, stuff has happened in that holding pattern. We saw mortgages rip, last week in tighter for some pretty wide levels. So many things to watch for as we sort of wait for these key events to unfold. Really appreciate you taking us through that. I would, you mentioned earlier your latest macro musings blog. I just want to highlight this for our listeners. This is something that George puts out periodically. You'll get it via your salespeople. You get it via the U.S. macro strategy website, as well as in LinkedIn or Twitter. And if you are not receiving George's strategy reports or other information directly, please do feel free to get in touch with them. Great stuff as always. Thanks again, George.
Thank you, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.